My name is Simon Brown. In this video for Finweek, we want to look at what to buy. Now that's a huge question. I could stand here and talk for days, weeks, months or even years, and I would have barely have scratched the surface. But there are a couple of key points that I want to touch on that are critical to take into consideration when deciding where to invest your hard-earned money. The first point is buy winning companies in winning sectors. Sectors are industries, banking, retail, perhaps manufacturing or telecommunications. You want a winning sector because that gives you uplift. If the sector is doing well, the companies within it will be doing well. The inverse is a sector that's underperforming, that's massively struggling. Even the best companies in that sector are going to be struggling to increase their profits, to increase revenues, and to give you as an investor a good return. Having decided on the winning sector, you want to buy the winning companies in there. Far too often, you'll find a winning sector and we'll go and buy one of the losing companies, one of those that are struggling in the hope that the company will turn around. And it might. But typically what happens is winners carry on winning. They carry on dominating. They use their position of power, their winning status, to only improve their profitability, improve their revenues. And the losers find it harder and harder to catch up. And that then brings us to blue chips. The phrase comes from the poker rooms of the 1920s, when the blue chip was the most valuable chip on the table. Blue chips in the investment parlance is the most valuable companies. Those big giant ones. Typically, they're companies that have got what we call a moat, an investment edge. Something that's going to make it very difficult for other new entrants to come and compete against them. That moat might be a brand, such as Coca-Cola. It could be a product, such as a cheap banking account. It could be a technological advantage over the competitors. But these blue chip companies also have got long track records stretching back decades of improved profitability, revenues that go up, dividends that keep on increasing to shareholders. These are the best of the best. You're not going to find hundreds of them at the JSE. Perhaps you're going to find a couple of dozen. These are the best companies to be investing in. They're the winning companies, they're in winning sectors, and they're most likely to continue winning. What's also important is to diversify. You don't want all your eggs in one basket or one particular share. That's too high a risk. So you want to diversify across different industries. You want some retail, some banking, perhaps some manufacturing. You also want to diversify perhaps within sectors. So if you think retail is the future of the next many decades, you don't want to necessarily buy just the winner, you buy the top two winners within that particular space. You don't want only to invest in companies that are focusing on South Africa. What happens if South Africa goes into recession or having a tough time economically? You want those companies that are doing business all around the world. The good news is that if you look at the big companies on the JSE, around 75% of their profits come from beyond the borders of South Africa. So you would buy a JSE listed South African company, but their revenue is going to be on a global level. And perhaps the easiest way to get diversification and to a degree to get quality is something called exchange traded funds, ETFs. These are like unit trusts. They're a basket of shares that are put together and then essentially sold to you as a single basket. And what they will do is they will track a particular sector. For example, perhaps the financials or the resources or industrials. Or they just track the broad market in the top 40, which is our 40 largest shares on the JSE. ETFs are cheap, they're passive, and they give you instant diversification, if not across sectors, certainly across companies. And then a last word of warning. Careful of thinking that you could buy that small little penny stock, that hot tip, the share that's maybe trading at 10 or 20 cents, and it'll double in a hurry. As we've mentioned in other videos, those very cheap shares are often cheap because the companies are struggling, because they're finding it difficult to raise revenue and improve profitability. It really is about buying the winning stocks in the winning sectors. Now that you've decided what shares you want to buy, you need to complete the transaction. Contact your broker or log on to their website if you're using an online environment. Tell them what share and the quantity you want to buy and the price you're prepared to pay. Remember, transaction fees will be added on top, and your broker will be able to tell you what price the sellers are offering their shares. If you're happy with that price, the transaction will be completed within seconds and confirmation sent to you. My name is Simon Brown. You've been watching another Finweek video on profiting from the JSE.